Okay, guys, since this course is meant to be so educational, I want you to really pay close attention because now we're going to go over all of this necessary information. You need to learn this, guys. This stuff is powerful. You will absolutely master Forex if you use this the right way. This is how I'm able to win 400 to 500 pips in a week easily. This is a no-fail method, really, if you can use it right. Now, hear me out. You have to be focused. It's a lot to take in and probably the most information I've ever had to understand in my life before trading, but this is worth it. This will be the holy grail for you. So let's get started. First, you're going to need your chart set to any currency pair. So I'll set my chart to the Euro USD, and normally I do this on Thinkorswim. I will take the actual trade on my Forex platform because I love Thinkorswim so much. And I find the Forex charts to be kind of choppy and annoying, so I keep it Thinkorswim. Then you'll need to set your chart to the 15-minute chart. Normally, I look at the 15-minute chart and the 1 hour time frame only. The 15-minute will show you similar information to the 1 hour, but the 15-minute will give you the precise entry to take the trade. The 1 hour can also give you an idea of when the trade is set up, but the 15-minute really gives you the meat and the potatoes. The way this strategy works is we're going to be trading in line with a huge market maker reversal that happens on pretty much all currency pairs. 9 times out of 10, it's dead accurate. This reversal is a famous reversal, of course. I didn't invent this stuff, but this is highly top trader stuff. The people who know this and are using it must be banking pretty hard because it's a great strategy to trade with. You're basically trading against all of the other retail traders that are trading, getting trapped in the market maker cycle. And here is how it works. We are going to teach you the basics, and then we're going to go into some advanced stuff. The market maker opens up the market on Sunday night. During this time, the market maker will generally make a move early morning or Sunday night. The reason why is because over the weekend, the market maker has usually closed the previous trading session in the range, and they've accumulated a ton of orders, and now they need to do two things. The market needs to close the old traders who placed a trade in the direction that the market was moving in and out of the market by shifting them out of the zone, and then they bait the traders to go into the false direction of the price by moving the price in the false direction heavily and then shifting it on them so that the market maker can make their move and earn their profits after they jump in. Now, when you think of the traders in the market maker sees them as fuel and profit in and of themselves for the market maker to continue earning money. The market maker has only a few tricks that he can use to trade in the market. Trick number 1 is the market maker will induce you to take a position in the market. This is done by using a few different techniques to manipulate the price movements and to get traders to take positions in a certain direction, but quickly reversing the price against you. The way that this works is the market makers will sell to you when the value of a certain asset or currency is low. And when you feel a lot of uncertainty and you want to close your position, they'll sell it back to you high when you think the market is spiking and it's about to go on a serious rise. And then they will reverse you out again. Trick number 2 is they like to hit your stop losses and knock you out of your trades. A stop loss is a limit that you set when you enter a trade that will automatically direct the trade to close once your money is too far in the negative. This amount could be set to 10 pips, 15 pips, 30 pips, 100 pips, and so forth. I would never set my stop loss to be 100 pips then pull me out. So I wouldn't set it to be negative 100 ever. When you're trading this method, the price should never go out of the money. And if it does, that's when you should let it hit the stop loss and then it'll close the position out. Now, when you think about it, you shouldn't have to lose money when you know what the market is doing. So in a sense, as soon as we aren't in profit, we need to get the hell out. Trick number 3 is they like to create massive chaos in the market by inducing emotions into traders. These emotions will consist of greed and just total uncertainty. Most traders will feel compelled to get in or out of positions when unpredictable price movements come out. These movements will include fast spike moves or huge candles when you see a candle that's really large. The news can cause this to happen, and also just random price behavior. This kind of stuff forces people to open and close positions. Many traders are afraid to lose, so they close out their position, and many traders want to win, so they open a new position going the direction of the price, and usually they're just going with the direction because it seems to be the logical route to go. That's when the market maker many times shifts the zone away from them again. Where we come in is we aim to get in when the time is right for the reversal to come. The market maker generally can only move the price about 200 to 250 pips a day. They're limited by the American Depository Receipt, I believe it's called. And they're also limited by an organization called the IMF, which limits how many pips they can actually move the market per day. This is so they can't cause an economic collapse with the price manipulation that the banks do every day. Here is how the process works. First, they will entice the traders to place a position by making them think that the price is or isn't going to move in a given direction. They will also hit the traders emotionally by changing the ways the market is moving. It'll sometimes speed up drastically, and then it'll sometimes slow down. Once they've caused the traders to place their trades, they will cause the price to move in a way that moves it against the traders, and they will then buy back the currency that they sold at a higher price at a lower price. So it's like a great big scam. A lot of times, actually, you'll hear me say that a move is happening during news, even when the news seems to be not affecting the markets too much. That's because the market maker has certain patterns that they will go into when they're ready to make their moves. They will also need some things to cover up their plans, and that is what they use so that they don't keep the public suspicious. So one of those things is news. Another is the little numbers that come out that don't make it to the big news alerts that you can find on investment websites like investment.com or forexfactory.com. So the market maker generally wants to do a few things. He wants to push the market into your hands so that you can think that you're going to pull a profit, and then he wants to pull the market against you once you've invested so that he can take your earnings from you. And what we're aiming to do is to get in right when the market maker has pushed the market into the hands of all of the other traders so that we will become profitable once he pulls it away. And here's how we're going to be able to do that. For one, we need to spot the cycles that the market maker first puts the public through before reversing the market. Then we need to go ahead and enter our position once we see that the reversal is about to occur. Once we're in position, we then need to drag our stop loss above our trade so that we do not get the price reversed against us, as we need to take profit so that when we have hit our pip target, we can pull out of the market. So in a nutshell, here is the cycle we've all been waiting for. Here's how the market moves, and here's what the market makers do to the traders every day to kill their accounts. First, I'm going to show you how to avoid that when trading forex. Then we're going to show you how to profit off of the builds that they give us every day. So when the market opens up on Sunday, it will usually open up in what we call consolidation. When the price has just been sitting and ranging between two different price points for a certain amount of time, this is called accumulation. The point of accumulation is to, let me go back. Accumulation and consolidation are kind of the same thing. When the price is just bouncing back and forth between two different price points, we call it accumulation, but the difference is that accumulation is when orders are being accumulated, and consolidation is when the price is just very consolidated. It's not moving too far out of its range. And those are generally the same thing. Well, technically they're the same thing, but traders kind of use different terminology for them. Consolidation can be any zone that's very tight, but that doesn't necessarily mean that the market maker is accumulating those orders. So I wanted to make that correction. The point of accumulation is to set false support and resistance zones so that the market maker can bounce the price between the 2 points. Traders think that the markets are hitting a true level of support and resistance when that happens. So they'll place buy and sell orders in the market when the price touches those levels, and when it hits resistance, traders will sell. And when it hits support, they will buy. Now, many of the traders take all their profit right there. Unfortunately for them, when they wake up the next morning and the US session opens and they see the price is about to break out in a bullish or bearish direction, that's when the market maker will spike the market either to the low or to the high, depending on what the volume looks like on the market maker's chart. So if you have a ton of sellers that are placing sell positions to be triggered when the price breaks out of that accumulation zone, for example, the market maker sees all that stuff. So you have all these traders who are putting their pending orders right below the consolidation zone, and then you have the traders who are placing their pending orders above the consolidation zone. And the reason that's happening is because the consolidation zone has been bouncing between two different price points, and then the traders are seeing those price points line up, and that's how they're drawing their support and resistance lines. So you have a ton of traders who are placing their pending orders right here, because we all know that when the price hits support and it closes beyond support, it's said that the price is going to fly. But really what's happening is it's just a ploy, okay? The market maker will move the price either to break through support or resistance, and this has to happen every day. The market has to break out of consolidation. So people are waiting for this, and the market maker is simply baiting for traders to place their positions, and then once they have enough volume in either the buy or the sell position, they will move it against the majority of the traders. So if majority of the traders are selling because the price is starting to break out of this consolidation period, the market maker will have to take their profit. So if the sellers are dominant, the market maker will probably pull it out of consolidation and then shift it against them. And so what that'll do is all of these people who were buying, they will be they won't even be pulled into the market yet. But the sellers, the people who are going to sell, are going to be brought into the market right here when the market breaks out of the consolidation zone. So they'll trigger their trades, and once they trap them, they'll pull it away from them, knocking their stop losses out of the zone. And then they will trigger the buyers to get in. The buyers will be all excited because they're like, damn, we're about to make a profit. And then they'll maybe move it in their direction a little bit, and they'll yank it away from them again. So they will bait basically everyone. Once the market maker sets their trap move, he will then move the market on the 3-day cycle. You should not be in on the initial Sunday to Monday move. It's a trap, okay? The market maker will set a certain pattern after this trap has been set. I call this the pattern, the McDonald's or Wendy's pattern. The McDonald's or Wendy's pattern can be seen on your chart as an M or a W forming right before your eyes, okay? This is where we take all of our profits, and this is how it works. The market maker will first get started, the market will get started in its true direction by spiking the price to the high or to the low. After that, the traders are of course going to trade the high or the low reversal. Now, once that happens, the market maker will increase the spread so that the traders can't take their profit. By the way, to simplify what the spread is the difference between the buy and the sell price rates. So basically, the dealer will sell you a currency at a rate of, let's say, 1.5891, but buy it at 1.5889. This means that there's a 2 pip spread difference, and this will determine how much profit you can take on all of the movements based on that amount of direction that the market is going in. So, for example, let's say that there's a 3 pip spread and the market moves in your favor 7 pips. You will be able to take 4 pips of profit, but the other 3 pips are going to go straight to the broker. So during the manipulation phase, the market maker makes it much more difficult to take a profit, specifically during the stop hunt phase, because they increase the spread. So here's the pattern. The market will hit the high of the day or the low of the day, and then it will make a pullback of between 25 to 50 pips. This is so that the market maker can trap the traders into buying into the direction of the trap. Once the market has baited, or once the market maker has baited enough traders, he'll then throw a reversal spike or drop toward the previous high or low. But usually the market maker won't take it out, and I'll tell you why. When the market maker traps the initial traders at the high, he also makes them hit their stop loss when he reverses the market against them. So think about it. Once the market maker reverses the market back to the high or low, he then baits more traders to move in the sell direction. Then he'll snatch it from them by reversing it on them. And then as the price soars to a new high, many traders are now becoming emotional because they don't know where the price is going. Then the market maker will then trap additional traders trading in the buy direction and reverse it on them as well. However, you have to remember that there were traders buying earlier, and some of them still haven't hit their stop losses yet. That's why the market maker has to swipe the market against them before moving the price past the initial high so that they cannot close their trade in profit. Once that last reversal starts, immediately put in a buy or sell as soon as you see the first reversal candle after the double trap move. Here's how it should look. The market maker spikes the price to the high, shifts the market away from the buyers, stops them out, then reverses it against the sellers, trying to trade in line with the high reversal. They then trap those traders low by reversing the price back to the high. They then stop those traders out and then reverse it away from the early birds who were going long in the beginning. And the market maker then sets the market to go on the 3-level cycle in either the buy or the sell direction. As soon as that reversal starts, you should wait for the first 15-minute candle to close, moving in the opposite direction, and then you can jump in. We'll show you how to do that pretty thoroughly in this course. Now, once you're in position, the market will generally move in 3 cycles. There will be the first initial level of drop of anywhere between 17 to 50 pips, and then the market maker will chop the market and go into a minor consolidation or accumulation. The market maker will then push the price before going into the second level of drop, and then there will be a level of accumulation, again, a consolidation zone, and the market maker will push it into the next consolidation zone. After this consolidation zone is finished, there will be a new cycle that we call level 3, where very, very strange price behavior will happen. And this is good because it helps us spot out when the market is about to go on a reverse. Once the market hits level 3, it will go into all types of madness. But shortly after, the market will chop after the stir. And it will form out a Wendy's or McDonald's pattern. And you should already be out of your position by that time if you're new to this, because now the market is about to go the opposite way. And once you see that same reversal pattern that we initially seen form in the opposite direction, that's going to be our indication to enter in. Now, let's see. The market maker will once again induce traders to go short and then long. They will stop the long holders out on the second leg. They'll induce traders to go short, and once the 15-minute candlestick closes green, that's your entry to buy, and either take 50 pips profit or hold your position until the end of the day or the end of the entire cycle. So watch this video 50 times if you have to. In the next video, we're going to go into an advanced breakdown of this strategy so that you can fully understand how it works and be able to carefully trade it like a pro. Thanks, and stay tuned for the next video.